You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we're really cracking open a high-level global briefing. It kind of puts us right in the middle of this massive tug of war.
Yeah, definitely feels that way.
So our mission is basically to figure out what holds the real power over the markets right now. Is it these big, scary geopolitical flashpoints?
Or is it the, maybe less exciting, but still crucial domestic economic data?
Exactly. Every single piece of info.
Right.
I mean, from central bank minutes to headlines from conflict zones, it's all steering the flows. Currency, commodities, trade.
Right.
We're going to try and synthesize this whole landscape for you.
And what's really fascinating here, I think, is that the market is constantly, almost minute by minute, deciding which force is stronger.
Mm-hmm.
And in this current session, the result of that battle, it's a dollar that's steady, trying to find its footing.
Okay.
But commodities, highly volatile. You can really see the influence of both things hitting the tape almost at the same time. Weak European numbers on one hand.
Yeah.
And then Middle East tensions on the other. It's that push-pull.
Okay, let's look at the currency picture first then. The U.S. dollar index, the DXY, it's attempting a pretty meaningful rebound, isn't it? Pushing up above 97.45.
It is. And the irony really is that the dollar's strength isn't necessarily because the U.S. is, firing on all cylinders.
Right. And it's more because Europe seems to be stumbling a bit.
Exactly. It's all about that relative weakness. And the prime example today has got to be the German Ifo shock.
Yes.
That German business sentiment data, wow, it really delivered a massive downside surprise. Just huge.
And that hit the euro hard.
Oh, instantly. Just knocked the wind right out of it.
Okay, I need you to break this down a bit more. Why does this specific report, the Ifo, matter so much? It's easy to just see an acronym and a number drop and kind of tune out.
Sure. Well, the headline business climate number, it fell to 87.7. But look, the real significance here isn't just the number itself, it's the trend break.
The trend break, okay.
Yeah. This single poor data point snapped a clean 6-month run of headline improvements in German sentiment. 6 months.
Wow. Good.
So it wasn't just a bad number, it was this sudden, sharp reversal of what looked like positive momentum, and that's a massive red flag for growth in the Eurozone.
And the market reaction wasn't delayed at all.
Instantaneous. That one moment of disappointment, that was enough to knock the USD pair back onto what traders call a 1.1 even handle.
Meaning it dropped significantly, trading around that 1.17 level.
Precisely. It just showcases how vulnerable the euro is right now to bad growth news out of its core economy.
Okay, so moving on from Europe, sterling's still looking pretty heavy, right, after those weak UK flash PMIs earlier in the week?
Yeah, definitely still feeling the weight of those.
And over in Asia, dollar-yen actually firmed up a bit into the 148s.
It did. Hit 148.29, yeah. And that's because Japan's flash PMIs, they deteriorated too.
So it really feels like weakness is kind of the theme almost everywhere.
Pretty much.
Except, there seems to be one major outlier, doesn't there?
Ah, yes. The Aussie dollar. It's kind of the success story of the session, really defying that trend of softening data elsewhere.
And why is that?
Because it's Aug CPI, the inflation rate, it actually accelerated. It came in at 3.0% year over year.
Which is significant because
that figure hit the very top of the Reserve Bank of Australia's target range. So you've got clear, strong domestic data beating expectations. And right now, that's overriding those global jitters for the Aussie.
Interesting. Now, speaking of central banks, we also saw some defensive moves in Asia.
That's right. It certainly looks like traders think they spotted central banks playing defense.
How so?
Well, the People's Bank of China, the PBoC, they fixed their daily reference rate for the yuan just a little bit stronger than the market expected. It's a subtle move, but it signals they're managing its direction.
Okay.
And at the same time, traders were citing likely intervention from the Reserve Bank of India, probably in the offshore markets, suggesting they stepped in to steady the rupee after it hit some fresh lows.
So these banks are actively trying to manage the local jitters against this globally strengthening dollar.
Exactly. They're not just letting things run freely.
And finally, let's talk about that Scandinavian twist. The Riksbank in Sweden. They cut their rate 25 basis points down to 1.75%. Now, normally, a rate cut weakens your currency.
Right.
But the Swedish krona had what you call two-way action. Traders seemed completely confused. Why? Why did the market get so mixed up on that?
Yeah, it was fascinating because this wasn't a unanimous decision, you see. The cut included a hawkish dissent.
A hawkish dissent?
Yeah.
Meaning someone voted against the cut.
Yes, exactly. Key policymakers essentially stood up and said, hold on, we think this cut might be too much, or perhaps the next move should actually be up, not down.
Okay.
And then they coupled the cut itself with guidance saying the policy rate is expected to stay at this new lower level for some time.
So you've got the action, the cut pulling one way.
And the language, the dissent, the refusal to commit to more cuts pulling the other way, it's this impossible balancing act, isn't it? Trying to support growth, but also keep inflation expectations anchored.
Right.
That split vote, that uncertainty, it just gave the krona whiplash, sent it bouncing around.
That balancing act, that really takes us directly into commodities, doesn't it? Especially crude oil, which seems to be trading in this acute tension. Supply shock fears versus demand worries.
Yeah, this segment perfectly illustrates that core tension we talked about at the start.
Yeah.
You see these geopolitical flashpoints creating immediate, almost emotional price spikes.
Like with the Middle East news.
Exactly. Crude jumped, WTI hit $63.86 a barrel almost the second those reports came out, saying Israel's army had taken another step towards occupying Gaza City.
Right.
The market instantly priced in a huge risk premium. Boom!
Yeah, I remember seeing that spike. It feels like the market always reacts to the conflict first, right? It's the immediate fear.
It often does, yes. But what's absolutely crucial here is how short-lived that spike was. Those gains, they were given back almost instantly. And why?
Let me guess. The German Ifo print.
Bingo. Because that weak German Ifo data we just analyzed dropped right around the same time. And that economic data signaled weak industrial demand coming from the heart of Europe.
So the worry about future demand just swamped the immediate conflict risk.
Precisely. Sent benchmarks right back down to $63.25 within minutes. For that moment, anyway, the German businessman's mood was temporarily more powerful than a military headline out of the Middle East.
That's incredible. But the underlying supply picture, it isn't necessarily all bearish, is it? I mean, U.S. private inventory data showed crude stocks down quite a lot.
Yeah, down a major 3.82 million barrels. Which is definitely constructive for prices, especially since most analysts were actually expecting a slight build in inventories.
So that's a good counterweight to the weak sentiment from the IFO.
It is. And we also have some crucial supply flow notes to consider. Russia, for instance, restarted a second processing unit at Novatek's Uth-Luga complex. That adds physical capacity back into the market. And then on the geopolitical supply side, you had Iran's oil minister basically dismissing UN sanctions, saying they weren't really a burden on its oil sales, suggesting they plan to keep exporting regardless of international pressure.
So the supply picture is just messy. It's non-linear up here, down there.
Very much so. Lots of conflicting signals.
Okay, let's see how that industrial weakness is playing out in the metals market then. Spot gold seems to be pausing a bit, just below yesterday's all-time high.
That's right. It hit $3,791 1 ounce yesterday. Today's best was around $3,779. It seems like that stronger dollar we talked about is tempering the haven demand just a little.
Makes sense. Dollar up, gold usually feels some pressure.
Yeah, that's the link. Makes gold more expensive for people holding other currencies.
Meanwhile, copper. 3-month LME copper is really struggling to hold above $10,000 a ton.
And that's the European data again?
That weak European data is definitely weighing on the industrial demand sentiment, yeah. Plus, you've got things like typhoon risks in Asia disrupting logistics. It all adds up. And I saw even production planning is adding some volatility here.
Absolutely. Look at Peru's Antamina mine, a key producer. They put out some pretty contradictory forward guidance.
How so?
Well, they guided their 2025 copper output lower 380,000 tons versus 430,000 this year. But they guided their zinc output higher, much higher, 450,000 tons versus 270,000 this year.
So they're shifting focus, maybe. Or facing different challenges for different metals.
It reflects shifting resource strategies, maybe local operational issues, yeah. And then back on the demand side, China reported its August crude steel output was down 0.7% compared to last year.
So every little detail seems to reinforce this story of industrial demand being under pressure right now.
It certainly leans that way, yes.
Okay, shifting gears slightly to trade diplomacy. Now, these files aren't just about dusty treaties, are they? They directly impact who gets access to the commodities and resources we were just discussing.
Exactly. They're tightly linked.
So let's start in North America. The critical USMCA review seems to be moving forward.
It does. Ottawa confirmed that their ongoing trade discussions with Washington are basically rolling right into the formal USMCA review process now.
And Canada's stance.
They're signaling they are prepared to sign when the terms are right, which suggests, genuine negotiation momentum. They want to secure that future trade predictability.
Okay. And separately.
Separately, Canada also signaled some openness to talks with Beijing, specifically on steel tariffs, which kind of illustrates how countries are having to manage these protectionist risks on multiple fronts simultaneously.
Right, juggling multiple relationships. And that transatlantic industrial trade file, the U.S. and EU, that's still a major sticking point, isn't it?
Yeah.
Affects things like the euro's strength, LME copper pricing.
Precisely. And there's movement there, too. The EU's trade chief is actually scheduled to meet the U.S. trade representative this week.
And the goal?
Explicitly to try and revive those stalled metals tariff talks, steel and aluminum duties. If the U.S. and EU can find common ground there, it would have massive implications for industrial stability and those cross-Atlantic supply chains.
Yeah, a big one to watch. Now, what's fascinating here as well is the sort of strategic positioning we're seeing over in Asia, particularly from China.
China's Commerce Ministry came out and stated it will not seek preferential treatment at the WTO.
Which it sounds like.
Well, it's a significant diplomatic move, really, designed maybe to reduce external friction, make them appear more multilateral. And adding to that, China's premier expressed a willingness to enhance cooperation with Canada.
Linking back to the earlier point.
Exactly. It shows they're actively pursuing a bit of a diplomatic thaw, trying to improve bilateral relations, often using trade as the carrot, so to speak.
Okay. And looking ahead, there's a key upcoming meeting that seems to tie all these threads together. Trade, minerals, defense. The White House confirmed an October 20th meeting with Australia's PM.
Yeah, this is a major touch point. The stated agenda is broad but critical. Energy, critical minerals, and defense industry coordination.
So for you listening, what does that mean?
It means discussions about access to the very minerals needed for everything from the green transition to military hardware. Resources that directly impact the copper and zinc markets we talked about, and global supply chains more broadly.
All right, finally, let's turn to those security flashpoints. Because even if they get momentarily overpowered by, say, an Ifo print, they still set that underlying floor for risk asset pricing, don't they?
Absolutely. They define the background risk level.
So, starting in Europe, the focus is still firmly on NATO's eastern border, it seems.
Very much so. The U.S. Defense Secretary just reaffirmed with Estonia that any incursion into NATO airspace is completely unacceptable.
And this comes
as G7 foreign ministers have expressed real alarm over recent Russian airspace violations, not just Estonia, but Poland and Romania, too. And crucially, they're actively discussing imposing additional economic costs.
Meaning more sanctions risk is building.
That's the implication, yes.
Okay. Turning to the Russia-Ukraine theater, Kyiv seems encouraged by recent U.S. remarks, seeing them as a positive signal of continued support.
Yes, they welcomed those signals, but, the conflict itself remains kinetic. There were reports of overnight Ukrainian drone strikes on Russia's Neftekhimsalavat plant, for example.
And Moscow's response?
Well, Moscow countered pretty strongly, stating the idea that Ukraine can actually win territory back is, quote, deeply mistaken. So they're holding firm on their military objectives.
Wow.
But interestingly, at the same time, Moscow also said it wants to remove irritants in its relations with the U.S. So you have this dual track, again, ongoing military conflict, but also these slight diplomatic openings or signals.
Which is critical for understanding that future sanctions risk we just mentioned.
Exactly.
Okay, shifting south now to the Middle East. Here we seem to have simultaneous moments of escalation and potential de-escalation happening, creating huge volatility for oil.
That's a perfect way to put it. You've got France's president meeting Iran's president today, Wednesday, specifically to discuss the potential return of UN sanctions. That's high-level diplomacy.
And at the same time,
what's really fascinating is the potential for some quiet diplomacy in another area. The U.S. envoy suggested Israel and Syria might actually be close to some kind of de-escalation arrangement.
Like what?
Involving maybe a halt to bombings and limits on certain equipment movements. a localized step down.
But
then concurrently, you have reports reiterating that Israel's army has taken another step toward occupying Gaza City. Clear conflict escalation there.
So this duality, hope for de-escalation in one spot, clear conflict in another. That's exactly why the oil market is so jumpy and confused.
Precisely. And just to add one more flicker, there was a small maritime risk incident reported about 120 nautical miles east of Aden. Thankfully, the crew and vessel were reported safe, but it's another reminder of the tensions in key shipping lanes. Hashtag tag outro.
Phew. Okay. So if we try and synthesize this entire session then, the dollar found its footing, mainly because Europe tripped over that German Ifo data. Gold is kind of paused, reflecting that steadier dollar maybe.
Seems reasonable.
And oil. Oil is just perfectly trapped in that tug-of-war we keep talking about. Middle East risk headlines pulling it up, weak industrial demand data pulling it down.
Yeah, that sums it up well. And if we connect this to the bigger picture, it's clear that things like trade diplomacy, especially around those strategic minerals, and of course security concerns, whether it's the Baltics or Gaza, they remain the key underlying catalysts influencing market flows.
Right.
But today really proved that sometimes simple economic data can override that geopolitical risk premium, at least temporarily, instantly even.
So what does this all mean for you listening to this? Well, consider the Riksbank's rate cut, the one that came with that hawkish dissent, forcing the market to focus on future policy splits.
Yeah.
And think about that Aug CPI hitting the top of the RBA target, boosting the currency. We saw today how a localized domestic data release, like that German Ifo print, could immediately overpower the massive headline of geopolitical conflict, dropping crude prices in minutes. So this raises an important question maybe. What specific localized domestic data release? Maybe it's an employment report, a sentiment survey, a housing print. What should you be watching really closely in your own region right now to gauge global risk appetite?
Because in this choppy market.
Yeah, because in this choppy market, maybe the local business mood, that specific data point, might actually be your most reliable short-term indicator of where things are headed globally.
Yeah.
Something to chew on as you move forward.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.